Assalamualaikum warahmatullahi wabarakatuh and good day everyone. My name is Adam and I will begin our presentation by introducing the company involved in our CVP analysis, which is EcoGlow Lighting SDN BHT. EcoGlow Lighting is a Malaysian-based company that operates in the sustainable energy sector, producing and distributing eco-friendly smart LED bulbs known as EcoBright. The company has a manufacturing facility in Penang and distributes its products through independent sales agent and online platforms. In the end of the year 2024, EcoGlow sold 50,000 units of EcoBright bulbs. It's also launched a digital marketing campaign to increase its brand visibility and market reach. Looking ahead to 2035, the company is facing several business challenges, including a predicted 4% increase in raw material costs, rising market competition, and a potential decline in consumer demand. Despite these issues, EcoGlow aims to achieve 28% net income to sales ratio in the coming year. To help the company make informed decisions, we conducted a CVP, which is cost volume profit analysis, which allows us to understand the relationship between sales volume, cost, and profitability. Now, let's take a look in the income statement for the year 2024. EcoGlow recorded 1.25 million ringgit in sales revenue, with variable costs such as production and sales commission making up the majority of expenses. After accounting for both variable and fixed costs, the company earned a net operating income of 2,500 ringgit. This income statement gives us a clear picture of the company's current cost structures and profit margin, and it serves as the foundation for our CVP analysis and future recommendations. Thank you.
To begin the analysis, we look at the total sales revenue, which amount to 1,250,000 ringgit. The total number of units sold is 50,000 units. To calculate the selling price per unit, we divide the total sales revenue by the number of units sold. Therefore, the selling price per unit is 25 ringgit. Next, we calculate the total variable cost, which is made up of two components. The first component is the production cost, which amount to 625,000 ringgit, and the second component in this sale commission, which amount to 150,000 ringgit. To obtain the total variable cost, we add 625,000 ringgit and 150,000 ringgit. Therefore, the total variable cost is 775,000 ringgit. To determine the variable cost for each unit, we divide the total variable cost by the number of units sold. In this case, we divide 775,000 ringgit by 50,000 units. The result is a variable cost of 50 ringgit and 50 cents per unit. So now we calculate the variable cost to say the price ratio. In this analysis, we divide the variable cost per unit by the selling price per unit and then multiply the result by 100 to convert it into the percentage. So, we divide 50 ringgit and 50 cents by 25 ringgit and then multiply the result by 100. This gives us a final result of 62%. So now we move on to the fixed costs, which remain the same regardless of how many units are produced. The breakdown of the fixed cost is as follows: manufacturing overhead 120,000 ringgit, digital marketing expenses 35,000 ringgit, website maintenance 10,000 ringgit, factory rental 30,000 ringgit, administrative salary 60,000 ringgit, utilities and insurance 50,000 ringgit. To calculate the total fixed cost, we add all of these amounts together. The sum of this amount gives us a total fixed cost of 270,000 ringgit.
Assalamualaikum. My name is Nur Akilah binti Abdul Malik and my matrix number is 306673. And now I will be explaining about question F, which is contribution margin per unit. So the formula for the contribution margin per unit is selling price per unit minus variable cost per unit. So as we can see, the selling price per unit will be 25 ringgit and the variable cost per unit will be 15 ringgit and 50 cent. So when we calculate according to the formula, we will get 9 ringgit and 50 cent. So now I will be explaining about contribution margin ratio. So the formula is contribution margin per unit divided by selling price per unit and multiply by 100%. So we will get 38%. And for break-even point, which is in units, the formula will be total fixed cost divided by contribution margin per unit. So we will get 28421.05. Now I will be explaining about question I, which is break-even point in amount, which is RM. So the formula would be BEP units multiplied by selling price per unit. So we will get 710,526.25 ringgit. And for question J, which is net income to sales ratio, the formula would be net operation income divided by sales revenue multiplied by 100%. So we will get 16.4%.
For scenario 1, our goal is to find out how many EcoBright bulbs EcoGlow needs to sell in 2025 to reach a 28% net income to sales ratio. First, we updated the variable cost per unit due to a 4% raw material price increase. The new cost per unit became 13 ringgit, and with a 12% sales commission, the total variable cost was 16 ringgit per unit. We calculated the contribution margin as 9 ringgit and the ratio as 66%. Using the CVP formula, the company needs to generate 3,375,000 ringgit in sales, which equals 135,000 units at 25 ringgit each. This is the required sales target to achieve the 28% profit goal. In scenario 2, we assume sales volume stays at 50,000 units and we had to find a new selling price to still hit the 28% profit margin. We used the same cost structure and applied the CVP formula again. The result showed that the new price per unit must be 30 ringgit 67 cent. However, this is 22% increase from the original 25 ringgit price, which is risky in a competitive market. It might drive customers away unless the company adds more value to the product.
Hi everyone, for scenario 3, EcoGlow plans to improve sales and reduce costs at the same time. The selling price is increased RM28 ringgit per unit and the sales volume is expected to double from 50,000 to 100,000 units. At the same time, sales commission goes up to 60% and fixed costs are reduced by 30%. Now, let's look at the calculation. Total sales is 100,000 units times by RM28 ringgit, which equals to RM2.8 million. The production cost per unit after a 4% increase becomes RM13 ringgit. So, production cost will be RM1.3 million. Commission is 60% of sales, which is RM448,000, and the total variable cost will be RM1.748 million. Then, the contribution margin is RM2.8 million minus RM1.748 million, which gives RM1.052 million. Fixed cost after reduction is RM189,000. So the net profit is RM1.052 million minus RM189,000, which is RM863,000. Lastly, the net income to sales ratio will be 30.82%. In conclusion, this strategy works well because the company's profit margin is above the 28% target. So with better pricing, more sales and lower fixed costs, the company becomes more profitable. Next, let's talk about the scenario 4. In this brand, EcoGlow upgrades its EcoBright bulbs by adding smart home features. Because of this, sales are expected to increase by 150%, which means 125,000 units. The selling price stays at the same price, which is RM25 ringgit per unit. At the same time, the cost of goods sold increases to 57%, and digital marketing costs increases by 30%. Now, let's go through the calculation. Total sales is 125,000 units times by RM25 ringgit, which gives RM 3.125 million. The cost of goods sold is 57% of that, which is RM 1.781 million. So the commission is 12% of sales, which is RM 3,075,000. So the total variable cost is RM 2.156 million. Then the contribution margin is RM 3.125 million minus RM 2.156 million, which equals to 968,750 ringgit. Fixed cost increased to RM 310,500 ringgit because of the higher marketing expense. So the net profit is RM 968,750 ringgit minus RM 310,500 ringgit, which gives RM 658,250. So the net income to sales ratio will be 21.06%. In conclusion, even though sales increase a lot, the company still fails to reach the 28% target. This shows that higher sales are not enough when costs also increase. So the company needs to control its spending to make the product upgrade more profitable. Thank you.
Scenario 5, Option 1. Retain sales agent with 80% commission. For Option 1, we consider maintaining our current sales agent but increasing their commission rate to 18%. With a 50% increase in units sold, we project selling 75,000 units at 25 ringgit each, generating 1.875 million ringgit in revenue. The variable cost increases by 4%, making it 13 ringgit per unit. Sales commission amounts to 337,500 ringgit. Total cost adds up to 1.582 million ringgit, resulting in a net profit of 292,000 ringgit. This gives us a net income to sales ratio of 15.6%, which is still below our 28% target. Option 2, in-house sales team. Option 2 proposes replacing external agent with 8 in-house sales representative. We assume a 70% sales increase, giving us 85,000 units sold. The sales revenue would reach 2.125 million ringgit. At 13 ringgit per unit, variable cost total 1.105 million ringgit. The new commission is 4%, and total salary are 163,200 ringgit annually. This increases fixed cost to 433,200 ringgit. After all costs, the net profit is 501,800 ringgit, with a net income to sales ratio of 23.6%, which is significantly higher than Option 1. Comparing both strategies, we can see that the in-house team delivers a much higher net profit and income ratio. It also offers better scalability and more control over the sales process, while Option 1 gives moderate returns and Option 2 comes close to our 28% target. Therefore, we recommend going with the in-house sales team for a more sustainable and cost-effective approach. To help EcoGlow succeed in 2025, we recommend 3 key strategies. First, restructure the sales team by introducing in-house staff. This helps reduce high commission costs and gives better control over sales quality. Second, keep using CVP analysis. It allows the company to test different scenarios and respond quickly to market changes. Last, maintain the current price of 25 ringgit per unit. This keep the product competitive and avoid losing customer due to overpricing. That's all.
To conclude this project, analysis the cost volume profit CVP of EcoGlow Lighting, the company recorded a net profit margin of 16.40% in 2024, but has not yet reached the 2025 target of 28%. Various CVP strategy and approach have been proposed to improve the company competitiveness and long-term sustainability based on the data and this recommendation. They are the key to the future success of the company. So that's all from our group. Thank you.